Hey, everybody. On today's episode, Paul and I dive into a little play on words on some conventional wisdom that everybody hears out there. This buy term and invest the difference. Well, we've got a different approach. We call it buy time and invest the difference.
It's brilliant. So basically, we talk about in this episode, if you need time to build whatever it is you're building your nest egg, your war chest. If you need time to do that, you need life insurance. And if you want it to be an asset, it needs to be dividend paying whole life insurance. So give it a listen. We appreciate you guys, and we'll see you next week.
Hey, I'm Dave,
And I'm Paul.
and this is the Wealth Warehouse Podcast. All right, Paul. How's retirement planning going from the Army? That is.
It's going very well, Dave. Thank you.
Yeah.
It's
What do you have? Your schedule now sounds like my mom's schedule. I got a medical appointment on Tuesday.
Tammy and I had to go to the pharmacy the other day. We have like this like brown bags of meds and stuff, like two old people. But no, yeah, my time in the office is pretty much over. I've got a bunch of leave and TDY and a bunch of stuff to knock out. So tomorrow, which is I guess Wednesday, October 9th, will be really my last day going to the office forever.
Great. It's about time. So now we can record during the workday instead of after hours. Make it a
Yeah,
little
I've
easier on the
noticed.
schedule.
Yeah, too, and I've noticed, man, like, gosh, I've been in a lot better mood lately now that I'm like at the beginning of the end, I guess, if that makes sense,
Hmm.
of the transition out of the military. And it's been a good ride and whatever, but I've got other stuff I need to do and need to focus on. Need to focus on my health, my family, building my home and stuff like that. So
Yeah.
I'm glad it's over, but it's been good.
So did you sign up for the survivor benefit plan?
No, interestingly enough, we have to. That comes at some point here in the next few months when we have to
Yeah.
like just check the box saying I'm not doing that, and then your spouse has to sign as well because I'm her
Right, they
dependent,
do.
she's my
Yep.
dependent, right? So we're both not taking the survivor benefits plan. So for anyone that's not in the military, or if you're in the military, the SBP is basically an annuity that you pay into where you can pay up to you pay in premium up to 6.5% of your pension into this annuity, and then if you were to predecease your non-military spouse or the other spouse if you're dual military, then they would get a portion. They would basically get 55% of your whatever your pension was. So if your pension were 50%, they would get 55% of your 50%,
Yeah.
which ends up being like 25% and
So
change or something.
roughly it's a quarter of your base pay is what they get, right?
Yeah, that's what it ends up being. Like that's why I
Yeah.
said 25% and change. It's
Yeah.
something close to that.
Yeah.
So not much.
Not
But
much,
since
maybe, yeah, not much at all.
since I have, a ton of whole life insurance, Tammy has a ton of whole life insurance, we have the opportunity to just say no thanks to that, even though it's a good deal if you're uninsurable or whatever, you should be
Right.
taking those things. But for those of us that have adequate insurance and we have large convertible term policies in place so we can expand our premium paying ability, expand our IBC system, I don't have to take it. And I can sleep well at night knowing that the SBP would not even come close to paying a spouse, even if I died the day I retire, the day after I retire.
Right.
It wouldn't even come close because it's taxable. It's an annuity, right? Come close to, the tax-free death benefit that Tammy would inherit.
Exactly. So
Not even close.
instead of giving up 6.5% of your pension for that, which isn't even a guarantee because you have to die first and
Correct.
a couple other things. So you take on some risk there. Instead, you've actually created a scenario with your convertible term policy that you can put your entire pension towards whole life insurance premium.
Yes, and that's what I recommend people do. They don't use their pension to fund their lifestyle. They use it to fund their opportunity, emergency, and future just
Yep.
sequence of return risk war chest, if you will. by paying it in dividend, paying a life premium. And I jump started mine. If you remember, Dave, I opened up my pension policy back in 2020. So I redirected my TSP money that I was contributing to that into dividend paying whole life. So my premium or my pension is already spoken for as life insurance premium, and so is Tammy's. We
Yep.
will not touch our pensions, and that seems crazy to people. Whatever. But I'm thinking generationally. I'm thinking long range. I'm thinking when I'm an old man and she's an old woman, what that all looks like, and it looks great.
Yeah, and that's amazing. And I've worked with I've got a few clients active duty still, and we devised a plan where maybe they weren't comfortable putting their entire pension into whole life insurance premium, but what they're doing is they've created a plan where they're paying half of what they expect to receive in their pension when they retire as whole life insurance premium today. So when they retire, they know their whole life is going to be funded by taking half of their pension. The other half, maybe they intend to spend it or use it for, whatever to supplement or whatever they want to improve their lifestyle, but at least half of it's being earmarked for whole life premium.
Yeah, and guess what? They won't miss those dollars. They're paying themselves first. They'll still have access to the growing equity of the policy, the cash value.
Right.
And what a great strategy. And they're going to look back someday, 20, 30 years down the road, and the only thing they're going to say is, "Gosh, I wish I had put more in."
Yeah, probably. But, they'll be very thankful with what they
No
have.
question. What a great advice that you're giving them, and good on them for receiving the information, putting in the work to study and catch this concept. So good for them.
Yeah. So, kind of moving into what we want to talk about today, of course, it's all related. Um, so, there's a very popular slogan out there, repeated by Dave Ramsey over and over, as if he invented it. He didn't, but
Yeah, it was A.L. Williams, I think.
yeah. So, but the popular quote everybody hears is buy term and invest the difference. And you hear it so much, it's conventional wisdom that if you do anything else, you must be a dummy. Well, we've got a different play on that. And instead of buy term and invest the difference, we would say buy time and invest the difference because we all need time to accumulate what we want to accumulate over our lifetime. If a man needs time, he needs life insurance.
Oh man. Oh, you stole the words right out of my mouth.
Yeah, yeah, I beat you to it. Of course, we
I
stole that
love
from
it.
somebody else.
It's so good.
Yeah, but if a man or a woman needs time, he or she needs life insurance. So what does that really mean, Paul?
Well, if you're a Dave Ramsey student and you subscribe to his what he tells people to do, the idea, and he peddles or he advocates, I should say advocates for
Pedals.
term insurance.
Yeah.
He's
Well, he does
peddling.
pedal because he does make money off of that. Of
No,
course, he's got
yeah,
affiliate links that go here
right,
to buy our Dave Ramsey recommended term insurance, as if he's not. He's just being
right.
altruistic. He's making money, lots of it.
Of course.
Yeah.
And I'm a capitalist. You're a capitalist. That's
Yeah.
totally
So
fine.
good on him.
So what what it means is you need time to build your portfolio, to build your business, to build your nest egg, to build your whatever, your war chest. That takes time. Very few people hit the Powerball for $1 billion
Yep.
or 500 million, right? They have to work 40 years to accumulate their assets and get that war chest established. So during that time, they need to protect their assets, their children, their wife, their spouse, whatever. And they do that typically, the typical everyday American does that with term insurance. And then hopefully they are taking the difference that they're saving in premium. I'm putting quotation marks because you're not really saving into an S&P 500 index fund or 401k or whatever. So that's what it
Yeah.
means. So you need
Yeah.
time to build all that up so that you can then self-insure in retirement.
Right. So you're buying that
Quotes.
time because if graduate today, you don't have time to build up what you were planning to build up over your life to support your family. And you don't want if something happens to you today, say you become uninsurable, you lose your job, you lose your medical qualifications to do your job, you can't make a living anymore because you're disabled or you die. Um, do you want your family's future to suffer because of that, or do you not, or do you want it to continue as you planned? So the compassionate, if you're a provider, your response should 100% be, I want it to continue as planned, even if I can't be the one that creates that opportunity. So, but what Mr. Ramsey recommends is, of course, buy term and invest the difference. And he recommends you only need life insurance until you can self-insure. Now, here's how he defines it, just straight from his website. Being self-insured means you're debt-free and have enough in the bank to take care of your dependents if you died. But he also says this, like, well, okay, great. How long do I need term insurance? He recommends 15 to 20 years, until your dependents are moved out of the house. So what has to happen in the next 15 to 20 years, Paul, where you can actually be self-insured? Like, so he's saying basically over the next 20 years, before your term expires, um, you know, move your kids out of the house, pay off 100% of your debt, including your mortgage, build enough up in investments in the bank and accessible cash that you can live off of for the rest of your life, and that your spouse can live off of if something happens to you. And what if you wanted to fund college for your kids, or the weddings for all of your daughters or something like that? You got to pay for all of that too. So
Yep.
all of that has to happen over the next 20 years for you to be
Good luck.
self-insured. Good luck. I mean,
It it doesn't take an incredible amount of brain power to think about everything that you just said and everything that you just outlined and do some, fifth grade arithmetic and figure out, wow, what he's advocating is not reality for most people. It
no,
it's not. And I'm sorry to say this, there's no margin of error in his plan. It all has to go according exactly 10% compound interest every year in the market, which doesn't happen.
no, it
Net
does.
of
It has to go
taxes, net of
exactly.
fees.
Yeah.
Right.
So,
None
what
of
are some
that is
things
going.
that could ruin that plan?
I don't know. A hurricane and you died.
Oh, a hurricane and your house got wiped out and you didn't have flood insurance, because you never thought you'd get a hurricane where you live, uh,
Yeah.
and you don't get that reimbursed. What if you become, um, disabled? What
Disabled.
if you get in a car crash, you have a traumatic brain injury,
Right.
and you can no longer work? You're pulling 100% disability from Social Security at that point.
Right.
Um, how's your plan doing then? Are you going to be able to get insurance again? Absolutely not.
Correct.
There's so many different things that could go wrong. If it all goes perfectly, great. I'm sure there are some examples of people who made it to being self-insured where everything went according to plan, but there's very few. Just think of your own parents. Everybody listening can think of their own parents. Are they where they thought they would be 30 years ago? I
No,
can
mine
tell
aren't.
you, I mean, my mom just married a doctor, a retired doctor and business owner. So, uh, she's good. But,
Yeah.
I'm pretty sure my dad expected to be wildly successful when he was in his 30s, to be wildly successful by the time he was 60, 65. You know, unfortunately, things happen between then and now. The best laid plans, it doesn't matter because there's third party performance, third party intervention that you have zero control over.
Zero control. Right.
Zero control. You could be doing everything according to the book and still be ruined, and not to your own fault.
Yeah, you and I and Mr. Ryan Fleming were speaking earlier this morning when we recorded another episode, and just think about we're in our mid 40s. Just think about how many people we've known that have passed away, unexpectedly, whether it was an accident, whether it was illness, but things happen, and those single digit numbers of people I know are starting to turn into using both hands. Um,
Yeah,
and they walked out of this earth way earlier than expected,
yeah,
right? And my first thought is always, I wonder what kind of coverage they had, because I meet a lot of people, especially you military folks. The only thing you have is your SGLI, and then when you retire, you have nothing. because you think you're going to self-insure. And maybe that's true for you because you have pensions or your wife has a pension as well. But most people don't have pensions.
No, they don't unless you're a government employee, a federal
Right.
employee that or a state employee that retires and you do have a pension.
Yep.
There are some companies that have some very, mutual life insurance companies. There's some that have
That
very
have
nice
pensions. Yep.
pensions for their employees because, they know what they're doing and they know how to do
Right.
that and keep it going for 100, 100 plus years
Right.
without interruption. Because yeah, they understand. But I did read, didn't Barry Dyke tell us companies are going back to that annuity type of platform instead of the 401k?
Yes, there's been a lot of, and you can Google this, folks, pension risk transfer. Excuse me,
Yeah.
to the to some large life insurance companies, and a lot of the Fortune 500 companies that you're very familiar with have been doing what's called pension risk transfer. So a lot of pensions are they're snatched up by these hedge funds, and they're the hedge fund gambles with that pension money and
Hmm.
is doing whatever with their own money, of course. We won't get into that, but read some Barry Dyke's books and you'll know what's going on. But yes, you're absolutely right. They're putting money with life insurance companies.
Yeah. Yeah. So, and as we stated on the last episode, life insurance policies back a lot of the financial transactions around the world. They just do
Yep,
because there's guarantees included. So they're a very, very important part of our economy, actually, that people don't understand that. So
yep.
you're actually improving the economy just by owning one of these policies.
And you're not contributing to inflation as much,
Right. That they can't do the
which is
fractional
also true.
reserve lending. They can't create money out of thin air and credit and give it to you. It's
That's right.
reserves.
It's
Yeah.
reserves. That's right.
Yeah. So one of the biggest things about that term argument is, you're buying a temporary solution for a permanent problem. What's the
Hmm.
permanent problem?
Death.
Death. Once you solve that problem, maybe you don't need that permanent life insurance, but
Yeah.
you are going to die. Everybody is. Um, you have, you know, you've got an expiration date. We don't know what it is, but it's there. And that's a temporary solution term, 20 years. Okay, 20 years in one day. I mean, what are the chances that you live to be 20 years older than you are right now? Pretty good,
Pretty good.
in the upper
Yeah.
90s.
Yep.
90, upper 90% chance that you're going to be alive 20 years from now if you're a middle-aged person listening. So what are
You
the
know,
chances of that policy paying out? 1,
I've been able
2%?
to. Yeah. Right. Yeah. Yeah. It's very low. It's
Yeah.
extremely low. Uh, I can't. I was gonna make a joke about the Clintons, but I won't. Uh,
You don't want to get suicided.
yeah, I don't want to. Shot himself in the chest 4 times and twice in the head.
Yeah.
Uh, but we, in my own family, we have, some needs of certain children. They're going to need like lifelong care, and if you had asked, my parents or my in-laws, had they been able to do what we are doing for our families and establishing for our families, if they'd been able to do that back in the 70s, they certainly would have. But how can you predict that it's going to happen? To one
Yeah.
of your future heirs, you don't know. But that's the mindset, right? Think generationally, and again, forgetting all that and whatever Dave Ramsey says. But I'm using this as my family banking system, right? I'm controlling the banking function, and by doing that, by practicing IBC, I'm automatically solving all these other problems, and I still have access to all my cash, and I'm going to have access to way more cash than I've paid in premium, like
Yep.
multiple times over. Like, and again, everyone wants what this can do, but once they find out, oh, it's you use dividend paying whole life insurance to practice IBC, yes, there's no better product. There is no better way to do it. Not IUL, not any kind of universal life, not a savings account, not a CD, nothing. This is the best way. So you want everything you can do, you just don't want it because
Yeah.
it's whole life. Because some idiot on TV tells you you don't need that.
Right. I always tell my my kids, especially in sports, there's only two things you can control: your attitude and your effort. That's it. Everything else is out of your control. What the calls the referees make,
Right.
what the opponents do, any cheap shots, anything like that, whether the ball goes to you or not, like you can't control that. You can control your attitude, your effort. There's a third thing you can control: the banking function. They're not quite ready for that talk. And frankly, I don't think it's appropriate for a sports pep talk at football practice. But at some point, they're going to learn that and understand that there's actually three things in life you can control. And the banking function is anything you can control. Why would you not want to control it?
Yeah, and of course, what Dave's talking about is, people used to control more of the banking function. And then, with the advent of advanced credit through credit cards, it's an easy, it's a piece of, it's your plastic, it's your plastic money that you just carry on in your pocket. It's very easy to just swipe that thing. It's the automotive industry has made it very easy to acquire financing for automobiles. And you go in there, they have the whole finance package. Oh, you want extended warranty, all these things. So, but very little attention has been, paid to helping you control the banking function. And it's all on purpose and it's all by design. They want your money for as long as possible. That's why all of these things exist. All this IRS code is designed to separate you from your money. This is the only way to take back control. It's the only way.
Right. Yeah, you make a good point. Just going back to the whole discussion of insurance, not just life insurance, any insurance. Uh, you know, Insurance of any kind is only worth anything at all if it's there when you need it. Like, is that true or not? Like your car insurance doesn't do anything for you. Of course, legally, it keeps you out of trouble.
Yep.
But until you, as long as it's there when you need it, that's when it's most important. That's the only time that insurance becomes important. So how often is term insurance going to be there when you need it? We're not saying term insurance is a bad thing. Just make it convertible term so you can
Yep.
convert it to permanent. And we have plenty of term ourselves in addition to whole life. But whole life insurance is guaranteed to be there when you need it. And what else? What else is going to be great about it at that time? It's You're going to have the most, and it's going to be the most efficient at the point that
Yep.
you need it the most.
That's what I was going to say. It's going to be the most efficient on the day you graduate.
Yeah, which means it gets
But
better every single year.
yeah, that's right. I look at my own, in-force illustrations or my own original illustrations, and you look at how much cash value, the increase in cash value relative to the premium paid in a given year, and in those advanced years, it's 4, 5, 6 times. Meaning, folks, every dollar that I paid in premium. So let's say it was 10,000. A couple weeks later, 50, 60 grand gets spit out the other side.
Yeah.
Where else can you do that? In a tax, quote, tax deferred, the way we use it with policy loans, tax-free environment, right?
And risk free. Where can you
Risk
do that risk
free.
free?
What is the economic value of certainty, right? Like, what is that worth to you?
Yeah, that has to play some kind of, so you can't compare apples to oranges. It's got to be apples to apples. So, I think most people think of insurance, period, as a sunk cost. I pay my monthly home insurance or my car
They do.
insurance. I didn't use it that month. I
Those are
didn't need
sunk
it.
costs.
It's sunk cost. I don't get that money back, period.
Nope.
Right? So people automatically think whole life insurance, also a sunk cost, right? Wrong. You're going to get back everything you ever put in and more. So you could either get back what you put in, or your beneficiaries will get back multiples of what you put in. It's not a sunk cost.
Yeah, so let me give like a tangible example that people can really understand. And this is assuming that they understand that the cash value is simply the present value of the death benefit, right? So it's the cash value that you have access to as cash that you can take a policy loan from or withdraw. We use policy loans. Is the present value of the death benefit. It's the equity in the policy. It's what the death benefit is worth now. I'm trying to say it in multiple different ways so you understand. But let's say I'm just going to pick an age. At age 75, which is a reasonable age, we should all be alive at that time. Let's say you have a policy, I'm going to make this up, that has, $1 million of death benefit when you're 75 years old, and it has $750,000 of cash value at the time. Let's say you're like, you know what? I don't know. I want to go buy 2 Ferraris.
Yep.
It's a terrible example, but we were looking at them the other day, and that's how much they cost.
Oh, that's right. We didn't even talk about that.
It would get you. Yeah, we should talk about that at the end.
Yeah.
But say you're gonna gift 2 Ferraris to your grandchildren, and then you do that. You go, you buy the cars, you take a policy loan, 750,000, max policy loan. There's a few thousand left over or whatever, and you get a discount for buying 2, so you put 50,000 back. So you took a $700,000 policy loan, and then the next day you graduate, you pass away. They've got the Ferraris, so you've got that asset now, which could be an asset depending on the
Could be an
model
asset.
bond.
Yeah.
Yep. Now you fronted yourself the $1 million of death benefit. That's all you did right there. Okay. So now there's 300,000 left over because you put 50 back after they give you that double vehicle discount.
Yep.
And now your beneficiaries get $300,000 tax free.
And the Ferraris.
And the Ferraris.
Yeah.
Could have been a house, could have been an investment, could have been whatever. I just use Ferraris because why not? It's ridiculous. So I say that to just point out you can do whatever you want with certainty. And it's going to be there to serve you well. Whether it's addressing sequence of returns risk because your other assets are the market downturn and you weren't smart enough to put your money in a guaranteed fund somewhere, or if you just wanted to do something else. Regardless, the insurance company does not care what you do as long as it's legal. Of course, let me caveat that. So that's the ultimate in control. That's the ultimate in certainty.
It is. So, buying whole life insurance, you bought time, which, if you buy term insurance, you bought time for 15, 20 years, whatever Dave Ramsey recommends you buy. But after that, there's no time left. You better be ready to go. You better have everything you ever planned on accumulating by that point that runs out, because maybe you won't be insurable to extend that term anymore after that.
Yeah, and I guess what I wanted to wrap up, and I forgot, was on that example is, that $750,000 of cash value, that was, and I'm making these numbers up, folks, all right? This is not real, but it's fairly close. That 750,000 was produced, let's say, with 450,000 or $400,000 of cash of premium paid.
Yeah.
Right. So I had access to way more cash value than I'd paid in premium. So in other words, without tax, it's not a sunk cost. I can recover more than I've paid in premium many times over. And the earlier you start, the better that example becomes. So for those children that we have policies on, their parents are paying $10,000 a year premium or $5,000 a year premium or whatever. Those kids, when they're 60s and 70s and 80s, will have millions of dollars of accessible liquid cash.
And even more in death benefit. Yeah,
that's right.
Because that death benefit grows every single year. So by buying whole life insurance, you bought time, but the time that you bought is the rest of your natural life. You bought up your entire life. And guess what? Every single year you live longer, your death benefit goes up, just like your cash value. So the longer you live, the more you're going to leave behind. So, and really it makes sense, because the longer you live, really the more you should be worth. Your net worth should go up, every year over the past year, just like your death benefit goes up to kind of, keep in pace with your net worth. It goes up, your death benefit climbs, but it climbs on its own. I mean, you just pay your premium and it continues to climb. It's not stagnant. And at the same time of buying that death benefit, you've done so many other things. And I think we'll allude to that perhaps on the next episode. All the different things that people are looking for, they're just looking for it somewhere other than in whole life insurance. because oh my gosh, whole life insurance, I can't do that. I want to find all those things that you can do with that somewhere else because I don't want to do whole life. So complete misconception and misunderstanding of what it is. But so when you bought your whole life in time, what does that free you up to be able to do? What kind of peace of mind does that give you?
Well, I'll tell you, I suppose it really helps you sleep better at night knowing that I actually been thinking about it more and more every time I get on an airplane. Is well, at least if these people, if something happens, they're taken care of.
Yeah,
Obviously, everyone's going to be just just super sad, but
for a little
but
while. Yeah.
fuck yeah, for a little while until they get those checks.
Yeah. Oh man, this will help while they're wiping their tears
This
with
will help.
$100 bills. Yeah.
but but it's nice to know that I've put the things in place to make sure that these kids won't want for nothing in a responsible way, of course.
Right.
Tammy is, a disciplinarian and I have friends, more importantly, I have a network of people. I've got my good friend here, Dave, that I know will look out for my family as well.
Right.
Right. And I always tell people we open these policies up, I'm like, listen, make sure your spouse who's not been involved in this process, involve her, make sure she knows how to access the policy, who I am, what my contact information is, because I should be one of the first phone calls
Absolutely.
if something were to occur.
Uh-huh. Yeah, I don't want to see a GoFundMe page pop up on my Facebook feed and think, "Oh, what's going on here?" Apparently, my client's husband or wife didn't know that there's a big death benefit payout coming. Get a
Right.
hold of me.
Get a hold of me.
Yeah.
That's right.
But some other things this does, it's the peace of mind, but it gives you a license to take a little more risk in life, to not put yourself on such a timetable of, hey, in 20 years when my term expires, my term insurance expires, I've got to have everything done, everything paid for, all my debts clear, which is maybe that's a great milestone to strive for, but people live on
Do
rice and
both.
beans to get there. Why would you want to live on rice and beans for the next 20 years just to accomplish that goal? And then you think you're going to change your lifestyle overnight? You just for the last 20 years have been living on rice and beans. You're not going to change overnight. And all of a sudden starting, going out to Manny's eating steak.
That's right. If I could
Yeah.
take the most disciplined people that are doing what Dave Ramsey says, for example, right? And put the infinite banking concept in a series of dividend paying whole life insurance policies in between what if they want to follow his baby step program, fine. But put this in the middle of it
Yeah.
and you will be far better off in a guaranteed in a guaranteed environment 20, 30 years down the road when you're on baby step 7 or whatever it is. You'll be better off. And I'm not making this up. This isn't like an opinion. It is a
It-
it is a
Mathematical fact. Yeah.
that you will be better off, that people who practice the infinite banking concept, apples to apples compared to somebody else who is not doing the same things, the person practicing IBC will be better off. And maybe there's some people trying to debunk all that, but I'm
Well,
sorry,
the people who are
it's true.
debunking it think that it's mutually exclusive, that if you do this, you can't do something else,
Can't
which
do
is
something else.
far from the
Right.
truth. This is the and asset. You can do everything you're doing right now and this. Just
Yeah,
add
absolutely.
this, put this in between where your money comes in to where it's ending up. Put this in between it. So,
Sequence of your money.
yeah,
It
all about the
matters.
sequence. So, buy time and invest the difference. I'm going to trademark that. Trademarked. I think
Trademarked.
that'll hold up in a court of law, right?
Wants a nickel for
Trademark.
everyone.
So if I hear anybody out there saying it, you owe me a nickel.
Maybe we'll co-write a book. That's a great title of a book.
Well, there's also another great title of the book that we'll say here in just a second. But hey, finishing these thoughts, do you have anything else? I think this is pretty good
No, not
play on
really. I'm
that
just looking at
conventional wisdom.
we're looking at our notes, and just to kind of rehash everything you said at the beginning, all those everything you said in the beginning about what they're teaching over there were just, those are just assumptions. You're gonna do this, you're gonna do that, and then this is the result. It's gonna be great. You're gonna have no debt. Screw the next generation, whatever. Those are all assumptions.
How would you like to have the answer be, this is the result if, versus this is the result, period?
Correct.
There's a big difference. That two letters make all the difference in the world.
Yep. Yeah. Certainty. So you could do the same thing, just do it with certainty. Like, why not? And
don't plan your future around the if.
And I guess I'd say this to some doubters is like, take a little bit of time, in the cosmos of time, investigating the infinite banking concept and really digging into the weeds about it with the right material. There's a lot of crap out there. The right material. If it's not clear after you do that, so be it. Right? This is caught, not taught. But oh my goodness, and you can't argue with these people on YouTube or whatever. I try once in a while. Like, they just don't know about the process of IBC, of course, but they don't understand the product of whole life, dividend paying whole life. They don't understand it.
Yeah, they don't understand
at all,
either.
And they don't care to. Right. So can't save everybody, unfortunately. So that's the way it is. So. But no, I think we about covered it. Man, that was a good topic.
And if you're listening and you haven't taken action on adding this to your life, not just your portfolio, but to your life, to your entire life plan, you need to contact us. So read Becoming Your Own Banker. Get on, what's the name of our website? thewealthwarehousepodcast.com?
Yes, thewealthwarehousepodcast.com. It's a little landing page. A little bit of simple, actionable steps you can take.
Yeah. Then schedule time with one of us. Let's talk.
It's and a lot of you have, so we appreciate it. More clients every week, every month. So it's great.
It's what we love.
But remember, in the end, this is about banking. This is about controlling the banking function. It's not about investing in life insurance. It's not about investments of any kind. It's about banking.
Yep. Absolutely.
If you can understand that, you can practice IBC.
All right. And to close out with another trademarked phrase, everybody, will talk to you next week. And until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.